Ladies and gentlemen of the crypto space, we're live on a Monday, March 6th. January, February, March already? March 6th at 11:30 a.m. That's a quarter. Well, end of the month. We're already a quarter through 2023 already. All right. All that remains is a very simple system, and that's what I am trying to hit on the most with how folks will better interact with markets. It could be any market. Obviously, we like the crypto markets, but it's actually harder in the crypto markets because this is the most volatile market. And obviously, a market filled with the most venture capital opportunities. Obviously, with venture capital comes basically, in many regards, a binary bet, either success or failure. And in that regard, we have very unique risk assessment processes that we really need to follow. And all of this contributes to surviving the complexities of engaging with a market over time. And when the volatility returns, it goes in one direction or the other. A volatility event is either to the upside or the downside, and there's plenty of reasons for it to go either way. The next volatility event is probably what's on most people's minds, and the odds are the next volatility event will be to the downside. But for the system to continue in its current form globally, that will have to be counteracted with um, uh, with intervention. That's just the nature of what the market has become. There's no organic recovery from home builders just literally defaulting on, double-digit percentages of their outstanding debt because they haven't sold a single home in 2 years. And were a catastrophic collapse in their velocity of sales, and unsold homes eats into their profit margin and maybe even their debt servicing obligation requirements. So that's just one of the systems that is under critical pressure to test whether they could actually survive that downside volatility event. And things build, momentum builds. So the downside volatility event is obviously foreshadowed by the tightening of capital cost, the increased cost of capital, specifically mortgage rates. And if the mortgage rates are as high as they are and folks cannot afford them, they're not selling homes. And that's just one market. That's just one market. And that's not even the plumbing of the financial system with LIBOR and SOFR and interbank capital flows and cross market capital flows, and the reality that we have achieved peak globalization, and now that's declining, and the reality of demographics and the constriction of population. If population isn't growing as much, there's a disinflation of population growth. There's much less labor in the workforce, and that results in the domestic U.S. labor market. The baby boomers are retiring, and Peter Zeihan would argue 2020 was a critical threshold of that retirement wave. There's less labor, younger people to perform the work that the older people are demanding. The whole structure of the market's changing. This financial system that was constructed pretty much in the 50s, I would argue, with the way money is created internationally, is not capable of withstanding this structural shift, this basically a demographics driven shift and a deglobalization driven shift. It was this status quo was a manifestation of globalization and the prevailing demographics trend. With the retirements, that demographics trend is changing. With the expense of things, there's less younger people, and that is a massive pressure on the system to structurally change. All of this leads to increased volatility, and I expect the next event to be to the downside. So the whole point of this stream today is a common theme that I like to talk about is how do you navigate a system that is expecting to have volatility events. So we could take the status quo of capital management, which is historically growth and value stocks, apply them to existing markets, and be considerate of this change of financial system structure. And we could even more so apply them to crypto markets, a maximum volatility market in a world that has structurally changing financial flows. And just because the system is changing doesn't mean the history of what people have learned of capital management needs to significantly change. I would argue much of it basically remains the same, particularly with regard to value investing. So notice we don't talk about growth. We don't talk about buy low, sell high, PVP, player versus player type strategy, which works, and some people are more mentally equipped to handle that activity better. And that the NFT space is hot for that. And smaller assets, micro caps, half a mil, 2 mil market cap crypto tokens with maximum risk profile and multi-sigs and all these capacity to mutate contracts. It's all over the place. But that's not what we focus on. We focus on the most important thing of a market. Existing in a market and surviving. Because when you're in a market, the market will change and grow and shrink and contract and have its volatility, but it will trend in a particular direction. And that direction the crypto markets are heading is that it's meaningful financial infrastructure. It's meaningful financial infrastructure because it's outside money. Inside money is trending towards CBDCs, which is control. Therefore, when you have a system that is not controllable without force, it's going to be a system that is going to be desired as a place, a destination for capital that's outside the controlled, regulated system of the CBDCs that are coming. So we could assess the risks of the crypto markets left and right, which is something we discuss. Clearly, you make Ethereum nodes illegal. It's a complicated situation, but it's not as simple as people fear. There's a big planet. There's electricity and internet connections to many places on the planet. So what happens is an arbitrage. And it's the same thing that happened to internet gambling. And the jurisdictions with the least regulation saw a massive inflow of activity. So the same thing would happen. And this is pretty much the end game I see for any large nation considering their cryptocurrency policy, especially the United States. Are they going to offshore all crypto enterprise and infrastructure? That's clearly not what they want, but that's what the regulations are doing. So that introduces risk, and that introduces arbitrage opportunity, and that introduces what I see in the market as a survivability characteristic. If the regulation sucks in the U.S., it goes somewhere else. The technology, the builders, they go into another jurisdiction. And you think we don't have access to these systems domestically in the U.S.? So my sentiment is the system is going nowhere. It's going to continue to grow. It's going to continue to thrive. It's going to experience its tremendous degree of volatility. There's going to be much more bullshit as compared to meaningful value allocation opportunities, systemic infrastructure. So it's not easy to navigate the system. So how do you navigate it? It's very simple, and most people overcomplicate the crap out of it with options and structured products and derivatives, and it's really as simple as identifying the assets that offer value, not just have value, offer value. So that's step one. You got to own assets. And the trick to assets is acquiring them at an opportune price. So we started this entire stream talking about the fact that volatility events are going to come both to the downside and to the upside. So the volatility event to the downside offers an opportunity to acquire value assets at a discount. Does that mean you don't acquire value assets at current market prices? Maybe they're at a discount to some degree, depending on what you're looking at. Maybe the market activity suggests acquire some, acquire a little, acquire a meaningful amount. Maybe you have no exposure to any assets that are productive. Maybe you need to start the core of a portfolio. I could see 20, 30% allocation in these market conditions as reasonable as long as you're effectively hedged. The fun part, the hedging. How simple is it to hedge something that is so incredibly overcomplicated? You hedge with dollars because dollars gives you the option to purchase value assets if a discount arises, if a value asset can be calculated to be desirably productive, and that's another story. What is the assessment of a value asset? How do you assess if it's a meaningful allocation? So let's go back to that in a second. But just because the market is boring, just because there's low volatility and we expect a downside volatility event, likely prior to an upside volatility event, doesn't necessarily mean you have to restrain yourself from taking any allocations. It means it's probably prudent to take a smaller size allocation. Bear in mind, all of us, especially folks that are listening to me, are working. They have income, or maybe folks such as what we've built on Discord over the last couple of years have capital flow, income from their value assets. So you're saving and accumulating. Maybe you're acquiring, you're compounding, or maybe there's a new asset coming online that's interesting and it's going to be speculatively productive. You can acquire. You need to have the hedge. You need to have the cash. Don't neglect the hedge because the hedge allows you to have optionality. Optionality is choice, optionality is power, and optionality allows you to buy egg sandwiches. So you have to have enough capital to do both. Don't forget that. So assessing a value asset basically comes down to a simple acronym. ROI, return on investment. Let me restart the YouTube browser. Oh, of course. I need to log back in. Why does YouTube do that? That's absolutely horrible. Please log back in while you're streaming. Absolutely incredible. Thanks, YouTube. There we go. ROI, return on investment, which obviously is APR. So let's say you have a 3-year ROI, that's 33% APR. So anyone who's allocating capital, even to equities markets, it's venture capital, especially to small penny stocks in equities markets, but everything is in many regards a penny stock in the crypto markets. So you have to think like a venture capitalist. And the most important thing is one, what's your ROI period? And two, are you getting enough quantity of the asset for it to be meaningful? And three, who else are you investing with? Who are your peers? And that goes into somewhat of a risk assessment as well, because if you are buying 0.1% and it's not enough of a discount and someone owns 25% and it rips 50% to the upside, your 0.1% made you a relatively small amount of return, and someone's going to reap a significant amount of capital gains, and there's your volatility event to the downside. So this is the complexity with a highly volatile market. The rapid price swings with relatively small amounts of capital allocation or deallocation really swings the price and gives you, one, a great opportunity to get discounted value assets, and two, means you could get a value asset overpriced relatively easily. But if you think about it from the positive perspective, the potential to acquire a value productive asset at a steep discount, depending on, you know, conditions, that's quite intriguing. That's not something you're going to get necessarily in the equities markets. You're not going to get discounted Microsoft 95% off. And it's not a productive asset. What the hell's an ROI on a Microsoft allocation? If you're making 2% on a dividend, you're talking about a 50-year ROI. Oh my God! Am I wrong to make this observation? Isn't that what an APR is? 2% is a 50-year ROI. From a venture capital perspective, that sucks. It's horrible. It's done. It's a non-starter. Oh my God. So, how much of this do we see? How much flawed logic do we see in folks that are trying to navigate these markets? And often it's glossing over or missing these very obvious characteristics. APR translates to an ROI period. The risk assessment, who's your peers? Are there sharks? Are you literally swimming with sharks? Not the best thing to do for a little goldfish. So take a step back, breathe, have patience. So many folks do the ever so popular aping, and that's taking action prior to thinking things through. There's times for that, and that's not now. The time for that kind of behavior, sure, is when there's significant liquidity inflow. If you have a 20% liquidity inflow into a market, you could do that. And that's exactly what occurred. Let's pop it over to the main screen. I've been chatting away. And we saw that on Arbitrum. Arbitrum had significant capital inflows. And now they look at the disinflation. We are at 9-10% capital inflows for Arbitrum for days, and now it's down to 1.51%. Obviously, things have started to sell off. One chart that we saw that with very obviously was this thing, because it was hot. It was up at 3. It was down at 1. Look at this volatility. 1.7. It was a little lower. 1.7, 1.6. Look at the volatility. Ooh, incredible. But look what happens when capital doesn't continue to flow in. That means the upward pressure decreases, and as upward pressure decreases, the sentiment changes. Oh, it's not going to keep going up as fast as it was, and then people get the fear spreads, and you get the volatility event to the downside. Let's zoom out, and let's just see how incredibly volatile it was. Price range. That was a 50% dip. All because liquidity inflows dropped from 10% to 1.51%. Imagine if you have a negative sum game. Negative sum game, that's when you see your volatility event of like 2022 for Ethereum Mainnet, and you have 90% drawdowns on even the biggest market cap assets. That's an obvious observation. Let's see how the other networks are doing for the fun of it. You're going to see stagnation. You're going to see a bit of boredom. You're going to see people heading out on the risk curve. I'm sure of late you've seen larger personalities talking about what asset? Some unknown new asset because it's popular and it gets a little bit of FOMO, and we haven't had that since 2021 and 2020. It gets the adrenaline going, and that's where the market is right now. Even the larger personalities are a little bit desperate for dopamine rush. Avalanche, boring, optimism, some nice flows. Optimism obviously has a boost with what Coinbase is thinking of and probably executing on. And controversial as it may be, um, it's big moves by big players with big capital and big connections, and they're big narratives. So it's very interesting to say the least. Solana's still bleeding a bit, marginally negative some. I mean, it's not really marginally. 1% is a fair amount on such a low amount of total liquidity in the system. Let's look at Mainnet. Zero sum game. So expect the boredom to continue. Horizontal, crab walk. There's no big liquidity. And obviously, I don't look at like Glassnode, and I don't really track stablecoin or just dollar flows into and out of centralized exchanges. I predominantly am only considerate of the DeFi space, which is fine. Um, so there's not much opportunity in these markets for a personality such as myself that has the capital management strategy that I deploy. Which is exactly why, probably since November, December, we've literally only talked about, what, 3 new protocols? Bunny is relatively recent. IPOR is relatively recent. We've known about Tapioca coming online. It was for many months now. So I very much look forward to that. Their beta in production is very interesting to say the least. Uh, I was looking at a couple of tweets to highlight to you guys what catches my attention the most. So obviously, this is an iteration functionally atop what Aave offers, a cross-chain money market. But this is a whole nother level. This is seamless. This has literally GHO. So it has its stablecoin component, which if done the way I think it's going to be launched, this has complete overtones of Liquidity. So this protocol has Aave rolled into Liquidity, considerations of Curve and currency recyclers, and the iteration of that narrative, which is not just Curve. Curve just started it, and we know how that's gone down the road with what Andre thought of. And this hits all chains simultaneously upon launch. So, Mainnet versus the L2s has evolved significantly in my mind, especially as Solidly came to Mainnet, and then you had the explosion of Solidly forks on the L2s. I don't think any longer that there's much room for alternative AMMs on Mainnet. Obviously, it's currently dominated by Curve. Curve has 4.65 billion worth of liquidity, which is literally microscopic on the global liquidity meter. Uniswap trailing close second with 3.65 billion in liquidity. That's Mainnet. That's your exchanges. And I find that quite fascinating, and I think this makes sense in my mind. Uniswap is going nowhere. It's entrenched, and it offers obviously functionality that's distinct from Curve. You can actively engage with the LP positions, optimize accordingly, and you could build derivatives, long, short, and do a variety of different things because of how they constructed their protocol to be generic. Um, and I think Bunny is in a good position to take advantage of that. Um, a lot of the sentiment that I expressed historically about Solidly is kind of leading towards what Bunny created. Why? I don't think there's room on Mainnet for another exchange. There's too much momentum and too much lindiness with Uniswap and Curve. I mean, look at Curve. Curve is meaningfully in the lead by $1 billion worth of liquidity. Uniswap is not as good as Curve in many regards. It's different. It's simpler. It offers more optionality to create structured products, and there's a huge contingent of new entrants to the market that just use Uniswap. They don't go to aggregators, and that is quite fascinating. That contingent. Do I have the breakdown? I think DeFi Pulse, DeFi Prime. Uniswap is far in the lead with regard to volume, which is quite fascinating. How fast? Look at that. 59% of all volume is just Uniswap. Curve has significantly more liquidity. That doesn't mean much. So what does this tell me? This tells me that, Timeless had the right idea. That Bunny is in an opportune position to really do something innovative with regard to a bootstrapped incentive system to bolt on a currency recycler to incentivize the liquidity on the largest volume DEX on Mainnet. And Uniswap's going nowhere. Quite obvious to me. I don't think there's room on Mainnet for another exchange. The L2s are another story. The L2s, obviously, Optimism and Arbitrum have gotten a lot of attention with the solidly forks, and they've done quite well. Velodrome has done very well. How long that lasts and the whole thing with OP value is another story. But that's separate and apart from the nature of the L2 markets are different than Mainnet. So Tapioca plays into this, seamless cross-chain. It's an Aave implementation. It's a Liquidity implementation. And it has the currency recycler-based incentive system implementation. So it hits the L2s. I think there's room still on Mainnet for Aave to have a little bit of pressure put on them. Are they behind the curve on GHL? I don't know, but I think Tapioca is in a good position to offer something interesting above and beyond what Aave currently offers. Just a couple of observations as to what's going on. And those are the three protocols that really catch my fancy. I'm not too interested in the L2s. The mainnet has the damn liquidity. Look at the total liquidity. There's liquidity, stables, overview. $134 billion worth of capital still remain in the crypto space. Look at BUSD. Wow. BUSD I would imagine is primarily BSC, albeit there was a fair amount on Curve. If I recall, there was a BUSD pool. So marginally negative sum, total crypto space. So expect PvP and people to capture those capital gains when possible. Marginally positive sum on Ethereum over the last 7 days. Total liquidity on Arbitrum and Optimism. Let's look at 5.88%. Optimism. So there's capital inflows, but they're disinflationary capital inflows, which doesn't support massive price appreciation to the upside. Let's hit some comments. We'll look at some other charts also. Try and help you guys out a bit. Vasco, Clever, what percent in cash versus bonds? Bonds are a risk-on play. Who's going to say that? 5% on a bond, you're talking about a 20-year ROI. It's risk on. Nobody's going to fucking hold that. If you could capture 20 years and get 100% on bonds in some sort of ridiculous volatility event, you sell your bonds. So no one's going to hold the bond for 20 years. It would make no sense. So bonds are a risk-on asset. If you're going to interact with bonds, you need a brokerage account that is equipped to give you quick access to buy and sell. Now, clearly, you accumulate similar properties to what we discuss and how I encourage people to engage with markets. You're trying to get the most discounted price, and bonds have been obviously crashing in price since the beginning of 22. So they're likely to continue to depreciate, which means yields go up, which has an interesting dynamic that I've talked about with regard to money outside the U.S. But in a volatility event, the return of risk off, the return of flight to safety could offer a large capital gains opportunity. 5% return, and if you can make 20, 30%, Why would you not sell your bonds and just capitalize? You know, with a large volatility event where bonds rip to the upside in price, it's going to get dumped on. I mean, do we have to pull up the 10-year? Yes, we do. I mean, look what happened here. So the monthly, let's go to weekly, a little bit more dramatic. I mean, look at the wick. Let's just zoom in. What an extraordinary wick at the bottom. Dump, 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 and it closed all the way up here. This is how much it got dumped in 1 month. And it's 22 bars. We need price. 192%, and that's on yield. 192%. I wonder what, I wish I had a bond price uh, chart, and that I think would be a little bit more descriptive of what I'm trying to convey. But that's a tremendous amount of volatility within a single month. So what percent of cash first bonds? Yeah, I have some bonds. I think I have some bonds. Actually, I know I have some bonds. I have some 10-year bonds, and they're down 15, 18, 20% on the money. But in a volatility event, those will certainly be positive, and I'll be able to reap some capital gains. But that's all they are. Bonds are a risk-on asset that are a hedge against volatility to the downside. What are you going to hold them for if you can capture 25 years worth of returns in a single volatility event? 1 or 2 year bonds? Well, I'm not too fond of holding bonds just for the return. They're not incredibly productive, even 5% on a 1 year bond. Go to the monthly. Even 5% on a 1 year bond is 20 years. 20-year ROI. So, sure, if you're 50 years old, 60 years old, and you don't need returns on your capital, and 5% is meaningful, maybe you have 5 mil and 5% gives you $250,000 a year. All right, that's considerable. That's very passive, but it's not incredibly productive. So I don't think it's a very considerable asset for my age group and younger. Now, I'm the oldest of the millennials, and that's a massive cohort of the population. But as I said, it's a great risk on asset. Bonds, risk on. Contrarian take? I don't know. Killis, hi. Raul, Gelds, Tapsy. On a Monday, thank God the weekend is over. I like the weekends. It's good to get away and relax. Dan, good morning. Slendo, +1 for egg salad Sammy's. Ooh, egg salad, not just an egg Sammy. Man said egg salad Sammy. Ooh, that's good stuff. That's good stuff. Joe, they're fishing. Yes, there's a lot of that out there, and that's what happens when the market gets boring. But obviously, when the market's euphoric, that just explodes as well. Critical mass. We, the crypto people, thoughts on Velocimeter on Canto, solidly fork. Will Cosmo assets come over and start bribing? I don't care. And I elaborate why simply by looking at this chart of liquidity. I'm a fan of Cosmos, the Cosmos hubs, and I think there is a good future, especially out in the East, Asia, so on and so forth. I think they're entrenched. I don't think they're going anywhere, and I have a relatively large position of Atom dating back to I don't even know when, late 2019, 2020, give or take, and I like it. It's done well. Um, how does that play into the DeFi experience that everyone is primarily accustomed to? It's marginal, meaning it's small liquidity relative to mainnet. Everything is small liquidity relative to Ethereum mainnet. We're talking 20, 30, 40, 50, and compared to Optimism, it's over 100 times more liquidity on Ethereum mainnet as compared to Optimism. It would be 67 billion at 100 times, and Ethereum mainnet has 80 billion. It's 120x the amount of liquidity on Ethereum mainnet. So that's where the biggest opportunity will be had is mainnet. If there's any capital inflow, it's going to go to mainnet, and then folks venturing out on the risk curve go to the alt L1s and the L2s, and you can have a playground. I mean, Arbitrum has been that playground for the last couple of months. I think Optimism has its narrative, and whatever ZK roll up is going to catch the bid first will have its place. That's great tech, very interesting. Privacy is a big deal. Um, dabble. You could dabble with the L2s, and just remember to section off a part of the portfolio, 2%, 3%, 5%. And if you turn 5% into 50% of the portfolio, just a 10x, that's extraordinary. Extraordinary. Changes everything. And you don't need to gamble with large amounts of capital. Just remember that the alt L1s and the L2s are going to be increasingly volatile. Watch the liquidity. As the liquidity disinflates, you get very obvious volatility effects. I mean, that's a massive swing, 50%. And what kind of liquidity is there on Arbitrum? And what is the nature of the future liquidity conditions? And that is what I think about most. I think the L2s, I think we're too early to really assess what the hell the L2s are going to be. Are they going to be financial markets, or is Ethereum mainnet going to retain like large financial market activity? Or will all that shift to the L2s as Ethereum mainnet changes structurally with regard to gas fees? But I always remind everyone that if a bank's going to roll around with a $50 million capital move, do they really give a shit if an Ethereum transaction is $1, 2, 3, 4, 5, $10,000? So this is what you have to think about as the structure of the system changes going into the future, and where asset ownership, where enterprise ownership is best served. So you're kind of speculating on where primary market activity will exist into the future, not necessarily where it is. But where it is gives you a good sense of where opportunity is right now, and that's the most important thing. That's how you can get a sense of whether to take a position or not. If something's producing a 3-year ROI, 33% APR, and you look at the technicals and it's significantly depreciated, that's potentially a meaningful opportunity. Oh, yeah, obviously does something like that. I mean, this, it's really hits so much of the narrative like spot on. I mean, look at the depreciation on this thing. I mean, this thing hit 94% down. It's currently sitting at what? 86% depreciated. How many protocols are accumulating it and recycling the currency at this point? And then if you go over to Vote Market, you can see what kind of returns are available. And this is aside from the derivative products that compound the transaction fees and whatnot. So this is obviously a boring week. The most previous week, these were much higher, but these are still significant numbers. A 4-year ROI. That's what 25% is. It's a 4-year ROI, and this has been going on for a year. We've had well over 20% APR available throughout the entirety of 2022 through all of that insane volatility. So now the asset is significantly depreciated. Oh, interesting. Um, yeah, we the crypto on the Solidly forks. I think I nailed a couple of good points earlier in the stream as well. Folks could return and hear what my thoughts were there. Vasco, I'm an Abe. Yes, we all are. But to survive, you cannot do that primarily. You have to be more strategic, more calculated, more surgical. I highly encourage at least entertaining to do things a little bit better in that regard. Soon, hello. Hope everything's good. Troy, Uniswap is also NFT aggregator now. They bought Genie. It'll be interesting to see where NFTFi goes. Most of it is PvP, and that's not a bad thing. It's just something to assess the risk profile of, assess position sizes, and I mean, there's NFTs to hold, and there's also NFTs to just get rid of when you could capture a 20, 30, 50% per return in a couple of days or a week. Um, NFTs are significant in my opinion. It's not the imagery, not image, uh, not trivial NFTs. Collections and art is meaningful, but what folks forget is that an NFT is a metadata storage capsule that's portable, and that's significant. So NFTs have their place. I don't know if the current uh, implementation, manifestation of NFTs is where things are going to be in 5 years. I highly doubt that. It'd be awkward if that's the case in 5 years' time. The odds are there will be products that are NFT based that we do not even conceive of today. Albeit gaming's a big deal. I'm quite fond of Gods Unchained. Folks know that. Joe, Velodrome is getting so much more participation than any other solidly forks. Yes, they are. A lot of it is optimism grants. Um, it's a big deal. I'm not gonna diminish the significance of what Velodrome has achieved. Um, what I do know is optimism has a very low amount of liquidity, so it's not risk, it's speculation that that quantity of liquidity is going to significantly go up into the future for a good reason. And now with Base on board, that is a narrative to consider. Um, yeah, in the end, you'll only be able to assess how well your chosen ownerships did in hindsight. So maybe 100x, 1000x in liquidity flows into optimism, and Base is some incredible catalyst. And then everything chosen on optimism would have been the right choice. Maybe Arbitrum is liquidity dwindles, or maybe the ZK roll-ups gets all the liquidity, and everything else becomes marginal. Maybe Ethereum Mainnet just retains all liquidity, and all the L2s are just not the chosen place for capital. So you'll only know in hindsight. So you want to diversify to hit narratives like this, like where's the liquidity going to end up? Where's it going to find a home? But you can't diversify too much, so you have to make large calculated bets. And this is like Buffett's ideology. Um, for me, that's just the lendiness. That's just the infrastructure. We'll see. We'll see. Only in hindsight will you ever know. Given the lack of bandwidth on mainnet for AMM besides Uniswap and Curve, where does this leave or a balancer? Um, do not take what I said earlier in the stream regarding Curve and Uniswap negatively for ORM Balancer. ORM Balancer have shown to have a place as a place to um, incentivize liquidity provisioning. Their BLPs are a big deal. They're bootstrapping for new protocols. They are a very tech savvy type of organization. What they've been offering, they've been really pushing the threshold of new innovative AMM configurations, choices, and options for products and services. So I have a high opinion of what Balancer has done since they launched. They've pivoted. And the most innovative thing, one of the most innovative things in all of DeFi really was their VE8020 VE BAL. A VE position that doesn't dry up liquidity. That's quite interesting. And they were the first to do that. They were definitely the first to do that. So that's a big deal. Like your VE position gives you voting rights, but it's still liquidity. In fact, it's locked liquidity. That's a big deal. So what do we know historically with regard to market leaders and followers? There's always a market leader. There's always a Microsoft, which owns the market, and then there's an Apple, which comes along and has something that's innovative, but they never disrupt the market leader, you know? And that was historically a race between Curve and Uniswap that doesn't diminish the likelihood that there's going to be other competitors, third, fourth, fifth tier. There's plenty of competition in markets. So what do we know? We know that Aura and Balance have significant momentum. They're quite entrenched. Uh, Definitely high opinion to such a degree that it's actually a significant position. I think it's 10% of the portfolio between VBAL and VL Aura. High opinion of what they've built. And I just am continuing to go back and forth which one I favor most in the long term, VBAL versus a VL Aura. I was contemplating migrating all of it to a base layer VBAL, and that might not be the best choice considering the structure of the protocol. It's different than Curve. It's very much a different consideration. VL Aura is powerful. Look at the amount of capital that gets thrown around, and it captures transaction fees, so that goes recycled right to the vote rentals. That's a big deal. I think it's uh, I think it's early to really say that VBAL is more significant than Aura, but I don't think I would say that. You only know in hindsight. Anyway, I don't want to digress too much on my burdensome uh, uh, contemplations on which is superior. The time tells that story. Reminds me, I still have to vote. I got 2 hours left. Um, Happy Monday, Cap. Hope you're enjoying the froyo yesterday. Took my girls out. It was a good day. My wife got to the mall, and I got to take my girls out. We went to the pool, and we had a good day. Those little angels. Would you ever LP in a cross-chain bridge like Synapse? No, I would not. I'm not interested in LPing much at all. I'm more interested in the transaction fees or getting a piece of the transaction fees of LPs. Now, obviously, this is called rent. And there's a lot of stigma associated with rent, specifically because that's historically associated with real estate, and no one's fond of the person getting paid rent. And people historically have a negative opinion of people that collect rent. And rent is also like middlemen, merchants, shipping, so on and so forth. Everyone takes a piece, everyone takes a cut. That contributes to higher prices for the consumer. So rent has a lot of stigma, but rent is the most powerful position to be in because rent means you made a choice to own something at an opportune price point, and the rent is a meaningful return with an ROI, and that's really a position that's the pinnacle of financial power in the current structure of global financial systems. If you have a capacity to live life on rent, other people are working so you don't have to. Now, I don't make the rules. I just observe them and isolate them, digest them, break them down, and verbalize them. Rent sucks, but you're either renting from or renting to someone. It's one or the other. And that is a simple choice. Hope that one helps. That's a big one. I haven't brought up that topic in quite some time. Renting from or renting to. Hey Noah, good to be here. Thoughts on DXY and oil volatility? Loki, we're going to wrap it up on a little bit of macro. Let's take a peek. Got oil higher lows for the last 3 months. You know, the SPR obviously distorted the entire market for the last couple months. It's a whole global story, and I don't follow geopolitics to that degree to understand what's going on, like the last week with regard to global oil demand. You know, China itself should probably push the world into a net shortage of oil situation. I mean, they're just going to want to keep growing, and their demographics are screwed, and they're obviously financing everything and perverting their currency creation and trend to an extreme at this point. So they're just going to keep consuming. Um, this is the base of most systemic volatility, or at least the majority of it. If oil spikes, there goes currency volatility, because currency volatility um, is the first knock-on effect of oil volatility. If you need oil, the simplest source for dollars are FX markets, which if you need oil, you need dollars. So obviously, we've talked to an extent about euro dollars of late. You need some time, because first you have to acquire the collateral at a discounted price, and hopefully most favorably not in dollars, because that defeats the entire purpose. So you need collateral that someone is willing to sell you not in dollars. So that means you need either a cross-currency swap that's available, or you need a broker that's willing to sell it to you in your non-US dollar denomination. And then you need the bank that is willing to accept them and give you the dollar quantity that's favorable for you, that's hopefully more favorable than acquiring the dollars on Forex markets. So the point is, this is the biggest precursor to dollar FX volatility, and dollar FX volatility just is a knock-on effect to risk markets. So obviously bond market volatility plays into that equation with regard to the euro dollar option. So if you need the time to acquire the dollars if oil spikes, and if there's bond volatility, now you don't even know if you could acquire a discount on dollar liabilities. And in that regard, this has more power to disrupt currency markets, because if you need the oil, you don't have time. So then bond market volatility is irrelevant. So both currency markets are affected by bond market volatility and oil market volatility, with energy markets, not oil market volatility, energy markets having more effect on currency volatility, because it takes the time out of the equation. If you need energy, you probably need it quickly. Let's take a look at move real quick. Disappointed, obviously, with last month's close, and it's holding support on the monthly TWAP. We are in very precarious times, very precarious financial situations, the bottom line. Volatility event to the downside, followed by volatility event to the upside. Look at 2022. What kind of perverted system is this? Do you think it's going to get less perverted? Hedge productive asset ownership with cash, and you buy discounted enterprise that survives the volatility event. If it survives the volatility event, it's more likely than less to continue to exist into the future and continue to be productive, because people see it, that it survived the volatility event. And you need cash to do that. That's the hedge. Don't need to complexify it trying to make capital gains on the downside with options and short positions. You're going to drive yourself mad. You go to work, take care of your family, you have productive assets, they give you cash, you save your cash, you have cash, you buy productive assets if they're at a good price. Otherwise, you have the cash, the market falls apart, great. You have cash. You can buy productive value assets. And meanwhile, the market is shitting itself, and your value assets are depreciating, but they're still productive. They're producing cash flow because you chose value assets that are productive, whether the market's shitting itself or it's doing well. All of 2022, there were vote rentals available for VLCVX, VECRV, VL Aura, VE finally started picking up in 2023. There wasn't much vote rentals available. Now there's a decent amount of vote rentals available for VE BAL, which is nice. So that's all that matters. What are your thoughts on Beats Innovation, the balance of fork? Beats was always interesting. Always loved their artwork wonderful protocol. Obviously, on Phantom just got drained of liquidity and has a lot of complex overtones to contemplate. Um, risk on, you know, we can make money with risk on, but I don't know. I don't have too much encouragement or passion about deploying capital to L2s. I barely own anything on L2s. I think it's too early to really know where the liquidity will settle. Alan, I see you're a fellow Mac user. I'm curious what apps are running in the menu bar. I see Nord, Push Bullet, Frame. Hey, yeah, it's a pleasure. Let me see if I can help you out. This is my camera. What is this? That's my eGPU. Frame. Crisp, this is noise cancellation for this microphone. That's about it. Push Bullet I don't even use anymore. I could just turn this off. I used it for a while. That's about it, and this is just my backup, my time machine. Steel Series, I don't even use that. That's just a configuration for my keyboard and get fancy colors. This is useful for your eyes, and you take some of the blue out of your screen. This is Drive, Google Drive, Sync, which is nice, and that's it. And that's Frame. I've been looking into what I can do on a Chromebook. I want a very lightweight machine to manage the business. So I think a Chromebook would be great, but obviously Frame has an application component, not just the plugin. So I need to look into how to do that because I'm not really inclined to use the MetaMask. We haven't used that in quite some time. All right, ladies and gentlemen, it's a good one today. The markets are a little boring. There's not much excitement, and that's okay. Don't force positions. People will go on YouTube and Twitter, and they're like, "Oh, what am I going to do? What do I do?" And there's just so much anxiety. And then you come on my stream, and you don't see the alpha. I mean, but I did drop 3 protocols. I mean, I guess that is a little bit alpha, but it's not oh shit, this is popping off. Oh, there's huge amount of liquidity. It's up 100, 200, 300, 500%. Don't kill yourself over that shit. One, the odds are you're going to lose capital. Two, that's not what a market is. That's not what a real value asset is. You came on this stream because we're looking to peer through the bullshit, peer through the madness to see something that's real, something that's interesting, something that is meaningful in this global financial shit show. So it's going to be boring. And that's okay. It's okay. I promise you that. Used to be all about seamless bridging. Now you're about L1. Not necessarily. Obviously, I have Stargate up here, and Layer 0 is powerful tech. So I have a moderately large STG position. That's sitting at about 5% of the portfolio at this point. It's gone up in value, which is nice. It's not very productive. So this stake unlocks. This is their offering, that initial offering, VESTG. So I'm going to move this over to a staked position. So I should double this. It's a lot. It's a fair amount of capital, and it's only producing $200, $300, $400 a month, give or take. Once I move that stake position over. So this is my exposure to the seamless bridging as well as tapioca. Seamless bridging and transaction fees and capital flow, liquidity provisioning, that's big stuff. And that's the spec bet that I would take on the L2s. Not the market makers necessarily over on the L2s, but just the capital flow, because on Ethereum Mainnet you get your finality. I think the future is probably you have your assets on Mainnet, you do a transaction, and it just accesses the liquidity everywhere on all chains and all L2s and rollups and whatever. And that would be an interesting future. So in that regard, you do your transaction on Mainnet, it gets liquidity everywhere, and you get your assets back on Mainnet. And to do that, you need stuff like Layer 0, stuff like Stargate, stuff like Tapioca, stuff like Synapse and Hop and the bridges and Who comes out in the lead? No one's going to know. It's microscopic markets. These are very low market cap assets, and the technology is dealing with relatively small amounts of liquidity. So that's my exposure. And I do have exposure to seamless cross-chain. But what do we know for certain, Joe? We know Mainnet has 30, 40, 50, 100x more liquidity than some chains. That's the bottom line. $80 billion compared to Optimism, which has $670 million. It's over 100 times more liquidity. So that is a massive consideration. $1.47 billion on Arbitrum, $80 billion on Mainnet. Apples and oranges dealing with Mainnet versus the L2s. Hope that helps. 36 people left in the stream, 14 likes. We can do better. Hit those thumbs up buttons. Thank you, everyone. Monday, March 6th at 12:31 p.m. Tell everyone to subscribe. Can only help people if they listen. I wish everyone a good week. I will see you guys on Friday after party on Discord for the most rational community in the entire crypto space. Have a good one.